The most important thing to me is to understand within the bigger trend which signals are showing up where.
Hello Rick, and thank you for joining Dukascopy TV today to talk all about your website, In the Know Trader, and talk us through a few different things we're going to go through. So thanks for speaking with us.
Thanks for having me, Jack.
And so let's start off by looking at why you concentrate on the technical side of analysis. What's wrong with fundamentals?
Well, nothing's wrong. It just doesn't give you the complete picture. So I've been looking at, well, technicals is really a subset of what I look at. I look at the entire behavioral side of the market. So anything that influences the decision that a portfolio manager makes is the type thing I want to get a grasp on, because the fundamentals, you need to know the fundamentals at the core. But prices so often move way away from fundamental value that I want to look at the other influences in the market, let the fundamental analysts do their stuff so that, let's say, the marketplace has that information. But I also want to be really keen on what's going on that affects market price, because when it comes down to it, people actually trade shares at different prices. And fundamental analysis gives you a theoretical value on where some stock or an index or something you're trading should be, versus the marketplace, which at any given time actually prices it at a certain point. And that's really what I want to concentrate on, because as far as I'm concerned, my goal is to make my clients more money than if they weren't talking to me. And only looking at fundamentals, we give the entire different piece, which is behavioral, technicals, and market timing.
So let's move on and look a bit at moving averages. Do moving averages come into play in your analysis much? I know that you've developed your own TMAP model that you've been using for a few years. Can you tell us a bit more about this?
They actually do, but I tend to use moving averages a little bit different than most people on Wall Street. Of course, most people look at a 50-day or 50-week and a 200-day and a 200-week kind of as just a core way of looking at basic trends. But let's say if you can pull up the weekly S&P chart for us, you can see that on this chart, and this goes back several years, we've got three moving averages, and this is part of the TMAP model. TMAP actually stands for Triple Moving Average Path. So this is a model I developed many years ago and have taught to well over 5,000 people on Wall Street. I'm much more concerned when it comes to trend analysis about the slope and the parallelism of moving averages than I am of any particular one crossing another per se. So if you look over the last several years in the S&P, and this probably goes back 6, 7, 8 years, the best moves are when, in the case of a bullish market, price is above these three moving averages. So which three do I use? Well, depending upon if it's a weekly chart or a daily chart. On weekly charts, I tend to use 34-week, 55-week, and 89-week moving averages to get the long-term trend. And you can see that kind of squarely in the middle of the chart, you've got three somewhat parallel moving averages with price leading the way. And those moving averages are in the correct order in the sense that that pink line is the 34-week, the green line is 55, and the yellow is 89. So when price is above all three, and they're all somewhat parallel sloped, positively sloped and parallel to each other, that's when you have your best moves. And you can see when they kind of condense together, that's when the market is going somewhat sideways and you're less likely to make real money. So if you look at the long-term picture of the S&P here, earlier this year, we went back into pure bullish mode. Price was above the upward sloping 34, the pink. That's above the green, the 55, and that's above the 89. And you can see they're somewhat spread out, somewhat parallel. And that has us fully bullish the market again. Our long-term view on the S&P, we came out with a piece back in 2013, which we constantly refer to. I put out an upside target I take it back, 2014, that the S&P would, in 10 years, by 2024, get to about 5,000. Now, at the time, the S&P was less than 2,000. So we're talking about major bull market in a 10-year period. So we are quite bullish still. There are going to be hiccups along the way. but we like the long-term picture, and as far as medium and long-term players, we're still fully invested.
I know you've supplied us with a chart here as well to have a little look at euro yen. Do you want to take us through that as well?
Sure. So we got long for our clients euro yen, I think it was a week to 2 weeks ago on the breakout of this particular model. Some of your clients might be familiar with it, some not. It's a Japanese model called Ichimoku. In the Western world, we call this a cloud chart. And when price had already broken above the cloud, in this case, that red and greenish shaded zones, and then the lagging line, which is that teal colored line, also popped through the cloud above it, you get a pure buy signal. Now, again, this is a Japanese model, and almost all foreign exchange traders in the eastern part of the world use this model as their core way of looking at the market. So I know, especially when it comes to something that is going to affect the yen, they're going to be closely watching this. And this actually gave a bullish sign in favor of the euro, doing better than the yen. So we got long at 127, I think was 36. We sold a third out last week on the high of the move. As we got to the 50% Fibonacci retracement plus the 200-week moving average, that's just where we've peaked. We've pulled back a bit. I still like this for the bigger picture. I wanted to take some profit at a logical place, but we think euro yen is likely not done on the upside, despite the fact that we've hit some important targets. But we're going to be looking probably to put that third back on, get fully long again on a pullback, and look for a move that goes higher.
Another chart we've got here as well is for the emerging markets. Do you want to also take us through that?
Yeah, so this is actually in the process right now of breaking out. This is a really good chart to look at that doesn't have a ton going on in it, in the sense that we haven't put a lot of models there. It's simply trend lines and a Fibonacci retracement. The most important thing is you notice that over the last few months, we have been consolidating right against where three lines met each other. The downtrend line from the 2008 all-time high, that kind of deeper teal line, the 62% Fibonacci retracement, which is the most important of all of them, and then an internal trend line. They all came there, and in the last day or two, we've actually gapped above, and it looks like EEM, which is the most predominantly traded emerging market ETF, is breaking out to the upside. So we think this is likely something that people are going to want to play to. Now, of course, realize this is, you've got dollar exposure here because these are invested names in local currencies. So as long as the dollar stays weak, this can do well. If the stocks don't move and the dollar gains strength, this will actually come down. So it's not a hedged ETF, but on its own right, this is showing upside breakouts. So this is pretty critical.
Let's finish up by having a quick word on signals. How do you deal with buy and sell signal at the same time in the same chart?
Yeah, you know, this sometimes happens, Jack. You get a bullish signal, and at the same time, a bearish signal shows up. And you know, as somebody who's looking at market timing and the whole confluence of indicators, it becomes a tougher call sometimes. The most important thing to me is to understand within the bigger trend which signals are showing up where. And the time frame. So if I'm looking at a daily chart and I get a short-term upside exhaustion signal, at the same time maybe MACD or something is giving me a buy signal, I'm going to pay attention to that short term. This may not be the best entry point. But if in the bigger picture we're in an uptrend and I know I'm looking to get long, then that sell signal that shows up on the daily chart might only hold me off for days or a week or two to get in, because I know I really want to be long, and it depends on how tactical I want to be. But I think one of the toughest things for people who are in this business is getting conflicting signals and how to deal with it. So a lot of it comes down to experience, how many years you've been looking at charts, as well as understand cycles in the marketplace. You know, I'm doing this 30 years, so I've seen lots of cycles. I've lived through the crash in 1887, the whole 2000 meltdown in technology, and the bull markets that have come since. So I think years of experience also has a lot to do with being able to navigate the markets and figure out what's going on.
Rick, thank you so much for sharing your insight with us. It's absolutely fascinating talking to you.
Thank you, Jack.
And thank you for watching. And to find out more and to see more videos like this, head over to dukascopy.tv. you.